Venture capital can return 70% annualized return. Although you might think it's all talking to founders and listening to ideas, there's actually math when it comes to venture capital. And we're going to look at the data as to how you can be successful in venture capital. So, venture capital is just investing money into early stage companies, or it could just be an idea. So, early stage venture capital is when you only have an idea, and here's the rate of return. The mean of like all of these VCs funding and return is 22%, but the median is 5.6%, which means the more you invest, the more exposure you can get to the outlier, which increase your return by a lot, 22%. Whereas late stage investing is more like investing in Series C or Series D. It's been established and very close to IPO already. You can see that the mean is much lower than that of the early stage, whereas the median is higher, which means you can make less investments and they're more likely to return you money. But overall, what you really want to do is put in as much investments as possible in early stage venture capital to really experience that power law. So in a perfect world, we'd have an index fund of all the early stage startup out there, but that is just not a thing right now. That kind of summarizes to 2.5% of venture deals generate nearly 100% of industry profits, whereas 4.5% of capital generated is from 60% of fund profits in the top tier funds. What that essentially means is that the difference between your Sequoia and an average VC is that they pick like 2.5 times better than a good VC. So that means they only need to make 50 investments in order to expose themselves, like 90% chance that they will have an outlier, and if they make 80, that's almost 100%. Whereas on only a good VC, you have to make essentially 100 to get maybe 90% exposure to one outlier. So yes, it still does depend on your capabilities to pick, because from 2 to 4.5% is more than 2 times. Then people also say that if you find a good startup, you should be doubling down your money as much as possible over the stage of that startup. But let's look at the graph here where we break this down into stages. And here's the company's ownership. Let's say if you put upfront and buy 3.3% of the company, and every term it gets diluted. So you put in more money, more money, and more money at higher and higher valuation, just so that you can keep the 3.3% valuation. And let's say you start off with the same amount of money, but you put upfront all of your investment at a seed stage at a much higher amount to get more ownership, let's say at 12.5%, then every round you get diluted. Then first round would be 8.9%, the next is 7%, next is 6%, and reality is you will still end up with twice more equity if you just put a lot up front right away and not make any further investment down the line, which actually doubles your return as compared to doubling down on your best investments. But of course, in order to increase that statistics, you need to better your decision making skills when you are picking your startup. So that comes to the qualitative, product market fit, the market map, risk and uncertainty, doing sensitive analysis, and seeing the risk and return. And at the end, it should kind of look like this. This is the probability weighted multiple on the invested capital. So essentially, you move on to early stage, and then it's either it's not going to move forward anymore, or you're going to continue and continue, and then you can either have a market leader, a challenger, and that kind of makes or break your portfolio. Follow me on Medium for more contents like this.